Our group is going to present about Macy's. U.S. retail sales are poised to maintain their strength aimed at low unemployment and high consumer confidence. Year-over-year, weekly gains for department stores are encouraging, supported by improved inventory positions and enhanced digital platforms. Macy's was founded in 1858 and in its first year had a revenue of $85,000. In 1902, Macy's moved to Herald Square. The company acquired Bloomingdale in 1949. Macy's operates department stores in the United States. The company also operates direct mail catalog and electronic commerce subsidiaries. Macy's retail stores sell a wide range of merchandise, including men, women, and children. In 2017, Macy's sold more than $24,000 billion, and it had approximately 130,000 employees. It has 690 department stores. It is present in 44 states, and it has online sales. Regarding the ownership summary, 92% are institutional holdings. The total number of holders is 704, and the total shares held is about 300 billion. Institutional investors are mutual funds, investment banks, and some hedge fund investors. In this case, the three major shareholders are Vanguard Group, BlackRock Inc., and American International Group Inc. Insider trading is the trading of a public company stock or other securities such as bonds or other stock options by individuals without access to non-public information about the company. Buying a company that has perspectives of decreasing its margins is rare. In retail hierarchy, Macy's is considered middle market department store chain. It has an ape-scale strategy to become positioned in the high-end department store group. However, Macy's strategies are failing. The recent use of celebrities in advertisement has succeeded in increasing brand awareness. However, the company failed to realize that such celebrities are not viewed as high-end product producers. Regarding the bargaining power of buyers, the smaller and more powerful the customer base of Macy's is, the higher bargaining power of the customers and the higher their ability to seek increasing discounts and offers. As for the bargaining power of suppliers, Macy's buys the raw materials from numerous suppliers. Therefore, the power of suppliers is low. New entrants bring innovation, new ways of doing things, and put pressure on Macy's throughout lower prices. For Macy's has to manage all these challenges and build effective barriers to safeguard its competitive edge. The threat of a substitute product or service is high if it offers a value proposition that is unlikely different from present offerings of the industry. Their strengths are high business credibility, comprehensive luxury products portfolio, and personalized merchandise offering. Opportunities: expansion is an overseas market, progress throughout e-commerce. Weaknesses: low inventory turnover, high rates of employee turnover, and threats: intense competition from other companies, as well as more affordable prices. The three main competitors are Nordstrom, that possesses a very high level of service and sells a relatively broad array of products at a moderately high prices. Kohl's are conventionally located in suburban areas and always feature easy access and low prices. JCPenney doesn't possess a high level of service and sells a relatively broad array of products at a moderate low prices. Since 2012, when e-commerce business began to develop, Macy's has been suffering a sharp decline all over the years. The revenue of the department store retail industry has been decreasing at 4% annual rate from 2012 to 2017. In the next 5 years, the decline will continue, but the decline rate is estimated to be smaller. The matrix on the left side of the picture shows how Macy's competes with its competitors in terms of market performance. Macy's has the highest market share, but the lowest growth rate, while Nordstrom, on the contrary, has the highest growth rate but the lowest market share so far. On the other side, there is a rather picture to compare brand equity among four companies. The further metrics are away from the center, the better this company performs on these metrics. The company with the largest area performs the best. Macy's long history enables people to treat it as an old brand, resulting on a loss of customer bases. The decreasing capability of Macy's is due to the competition with e-commerce and the increasing labor costs. As such, leveraging its portfolio might be considered. There is a low customer satisfaction, the demonstration of products is totally messy and confusing, and people can hardly find what they want. The high leverage impacted Macy's credit profile, making debt more expensive. This slide shows the annual balance sheet and income statement of Macy's. I would like to call your attention to the fact that the company do not pay dividends, and it is mainly financed by debt. especially long-term debt. This high leverage can represent risk. When looking to the company's ratio analysis, EBIT and EBITDA margins perspectives are to continue decreasing, as well as the return on equity and assets. That's a red flag. In a direct comparison, the shares are very cheap. As we will see, the company is creating value, has the largest free cash flow, and will probably increase its share prices. That is why we recommend to hold. We believe that a better opportunity to sell will emerge soon. Chart prices help traders see where price has been and by doing so provide clues as to where price will go. As such, understanding how to read a price chart is a key step in the journey to become a trader. Regarding Macy's price chart, share prices has been varying from $46 to $19 between August 2015 and August 2018. As we said, the prices are increasing because of the value creation we'll see in the next slide. Examining same-store sales is helpful to investors in determining what portion of a company's current sales revenues are a result of sales growth in existing locations, not accounting the opening of new stores. Nordstrom, which represents the innovation and the small players, is expanding, while Macy's couldn't show itself as a new company, not being able to open stores massively. The extent to which ROIC exceeds WACC provides the real value creation. The PE ratio, on the other hand, does not tell investors whether the company is producing value or how much capital the company consumes to produce its earnings. As we see, Macy's has a high free cash flow. With this free cash flow, the firm may improve its financial health, paying their debts and decreasing their indebtedness, for example. Finally, we have some market statistics that say that most analysts are suggesting to hold, so it's not just our perspective but an overview of the market. Macy's is a well-established, long-age company. However, the big department stores are declining in profit as more modern options are appearing, such as e-commerces. We recommend that Macy's diminish its debts as the high leverage makes its debt classified as riskier and therefore the interest paid are higher. The company is not in its brightest moment, however, it is generating cash and creating value, and it does not distribute dividends. However, it is creating value and price is increasing. Therefore, we advise to hold before buying the company.